Hello, everybody. My name's True Demon, and I'm the Devil Stockbroker. I wanted to make this video, which is a little bit unusual. Um, it's been a long time, but I felt like enough time has passed that I needed to at least give everybody a heads up of what's been going on with me. Um, so I'm okay. First of all, I'm still alive. Obviously, I've been extremely busy because of a change in my job situation. Um, I'm now in a bit more of a leadership position with my day job and my work. Um, and a lot of things have changed in my personal life that have demanded a lot of my attention in the last several months that have just prevented me from being able to generate YouTube content or spend time on trading. Um, a lot of people have had to make changes in the trading floor as well. I think it's not just me, it's pretty much everybody is basically dealing with the circumstances of the economy and just general life is, you know, life is getting complicated with the way that things have been shaking out, not just because of the market, but, the post COVID and prices rising everywhere. So there's a litany of excuses that I could give you, but more than anything, I wanted to let everybody know that I'm doing okay. But the content is probably going to continue to be very sparse and intermittent. However, I'm still spending as much time as I'm able to offer in the trading floor. And I'm still hosting meetings every Sunday with the Demons meetings to kind of give everybody my analysis of the market and keep everybody abreast. I am still tracking the market, still keeping tabs on everything that goes on, and I'm still offering my opinion and my analysis to people in the Discord. I just have not been able to do streams or do any YouTube content of any kind. It's been really difficult to find time, so I hope that everybody can understand that. This video, I'm going to actually share with you the meeting that we had this Sunday, which I opened up to the entire floor. So the full membership base of Hell's Trading Floor was able to attend if they wanted to. And we had a really good session analyzing the market, sharing uh, different views of what's been going on in the market and the situation to come. This is quite a long meeting. This is an unedited meeting. So you get to see the full interactions between myself and the rest of the crew in Hell's Trading Floor in our natural habitat, so to speak. And if you guys are interested in being a part of that, then you can join us at hellstradingfloor.com, and you can sign up for our Discord at discord.gg/Hell's Trading Floor. So, without further ado, I will get straight into it and enjoy your peek into the trading lifestyle of Hell's Trading Floor.
I love it.
Okay, so I got the recording going, starting up all my charts and everything.
Good afternoon, TD.
Good afternoon, no? Wow, I just got deja vu. All right. We got coffee charts and stocks. It's a good day. All right, so checking out the cues. We've got some really interesting setups here. Okay, so we got a few possibilities happening on the cues. This does look strongly like a market recovery right now. We're gonna check out the HYG and the SPY really quickly before we move on to the tech sector. So looking at the SPY and HYG ratio chart, we've had a consistent market recovery going all through 2023 since the Fed has stopped their rate hikes. They've gone through their pause, and the market bounce that followed has come in real strong. we've been getting stalled out at the ceiling here at 445. Now, I would be really hesitant to call this any kind of cup and handle. I don't see a cup here. Rather, what I do see is more like a 3 drives pattern or some kind of a harmonic. But we do have the possibility for the market to make a turn to the upside. The problem that I see here is that looking at HYG, we had a big gap down and a rejection on HYG and on the SPY. Okay, so we have these 2 hanging man candles. If we zoom way, way, way in. So these big hanging man candles suggest to me that we're probably due for some downside action. The market, well, I should go ahead and review the latest news from the Fed before I get too ahead of myself. But as I understand it, the Fed has been talking about resuming a hike. We're kind of watching jobs numbers and inflation reports. Let's see, did we already have CPI? I need to check if we actually did get CPI this week. On the 12th. So Wednesday, we get our CPI report. This is going to be a big influence on the outcome of the market and the Fed decision. We know that the Fed prefers their what is it? PPI, not PPI, PCE report. They consider that to be a truer gauge of inflation. And CPI, we know, is mostly focused on consumer staples. But regardless, the situation with inflation is what everyone has their eyes on. Everyone is continuously expecting inflation to slow, so everyone's really hoping to see the CPI report come in under expectation. The forecast is 0.3%, and the prediction or the projection is 0.4% for the month-over-month inflation report. Year over year is expected to be a forecast of 5 with a predicted 5.3. So if we end up coming in hot, that is if we do end up coming in over 5% year over year, then that would basically indicate that inflation has started to continue and is ramping back up. So if we end up breaking forecast, then that would probably prompt the Fed to continue their rate hikes, and that's going to send the market tumbling. So before going on, does anybody else have any thoughts of what they have seen, anecdotal stuff, or analysis on the broader market? Feel free to chime in.
And silence breaks across the land.
It's fine. I expect it. Okay.
Yeah, I don't have much to say. I mean, I just play trends, so
Well, what
you
about
know.
the car market, Prox? Because we've got car market was a big driver of inflation for a while, so I'm curious on what things have been happening in your sector.
I mean, it's mostly just been about financing. Inventory has picked up substantially for pretty much every major manufacturer. So we have more cars sitting on the lot now than we've had for over 2 years, which is great. We're selling them, but the problem has been financing. Interest rates are higher, so that doesn't lean itself to very interested buyers, especially in $50,000 SUVs. And I don't know. We use Mazda Financial, which is actually owned and run by Toyota Financial, and I don't know what bank they really go through, but they are not offering like any decent incentives. And when they do, they're very like pinpointed on like certain makes or models of our Mazdas. So it's like if somebody doesn't want that model, well, they're just kind of screwed on getting a good, a good interest rate on their loan. So for us, yeah, it's just been about interest rates and getting financing.
All right. Well, that's kind of to be expected also, because that's the main topic on everyone's lips lately. The 30-year fixed mortgage rate is projected to go up, and we're going to see interest rates rise again, especially with Fed rate hikes expected. Um, and right now, people are struggling to qualify in the housing market also. I keep getting hounded by mortgage originators because I reached out to find out what their interest rate offers were, and I wanted to see how they stacked up against a few others. And that was over a year ago. They won't leave me alone. I've told them repeatedly to take me off their call list, and they're desperate to get mortgage applications filled out because they're not bringing anybody in and nobody's qualifying. So I'm one of those, rare qualified buyers that I instantly pre-qualified. So they want me to buy a house through them, and I'm just like, you're so funny. Like not in this not in this situation. No, hell no. But whatever. Anyhow, um so continuing to see the we're continuing to see the banking sector getting ready to prepare to weather the storm while the market has been ripping nonstop. And now we kind of have this like stalling out in the market. So now, uh, going back to what we were saying about HYG and the SPY, we see that the SPY has created a double top, and I'm almost keen to call this a three drives pattern. A little bit wonky, so I guess it doesn't fit the model. But looking at this setup, we're coming in and getting stalled underneath this resistance. So we had resistance in the SPY back here at 450. We didn't even reach it. We actually came in just under at 445, and the SPY is getting stalled out. And now the bullish momentum has completely stalled. So no one's buying right now. We're not getting any. We're not getting any. Um, we're not getting any more volume coming into the market, and the price action is just kind of stagnating. So this is the sign of weakness that I think bears are looking for before they jump in and start pummeling the rest of the market. So we will probably see some downside action even before a CPI report. And if CPI comes in hotter than expected, then that will definitely further spur on a sell-off. So that's the thing to be careful of this week as we go into CPI announcement on Wednesday morning. And prices have stopped increasing quite so fast across all sectors, but I'm still seeing the price of goods increasing regularly at grocery stores. So staples and consumer cyclicals keep going up in terms of their expenses. So since that's been ongoing, hey tipped, got a hot mic, homie. Thank you. Um, since those prices have been continuously moving up, I'm still feeling like inflation is a little bit hotter than what they're expecting it to be. So let's also take a look at, consumer discretionary sector started screaming up. Consumer staples have stalled in terms of stock value. So let's go ahead and let's move over to the Qs, because this is the ETF that I'm most interested in. We still have quite a lot of strength in this one. The Qs have still been showing strength here. We had a bounce off of the 20 EMA right here, and now we're kind of settling into this range that's starting to shape up like a pennant. We have a bit of a bull flag right now. But this is the one sign of bullishness in the market that could carry this buy. The issue is that on the upswing, we had a huge drop in volume. Almost no volume happening Friday, June 23rd, and Monday, July 3rd. So the 4th of July week was a really low volume period. It's kind of normal, but seeing that the market stalled out on those days in particular, it's suggesting that the market is getting a little bit more nervous. I didn't even see this news yet, but this headline, stocks close lower as U.S. wage pressures keep the Fed on track to raise rates. Let's take a look at this. This is from bar chart. Stock index Friday closed moderately lower with the Dow falling 1.5 week low. Stocks initially whipsawed higher and lower Friday from the smaller than expected increase in U.S. June non-farm payrolls. Although weaker than expected, Friday's payrolls report was seen as not weak enough to dissuade the Fed from raising interest rates at this month's FOMC. Broader market recovered from its worst levels Friday on positive comments from Chicago Fed, who said policymakers are on a golden path to ease price growth without triggering a recession. Oh, they're so fucking hilarious. Does anybody in here think that we're not already in a recession? Is there
No.
anybody in the United States right now that does not feel like we're already in a recession?
No, we're definitely in a recession.
No. Yes, we are in a recession.
Yes.
They just won't officially come out with it. Got to save their skin.
Mm-hmm. Let's see.
Yep, one of two R words that you can't say.
Okay.
Can you imagine having a 90-year mortgage? Like, who does that serve? Not the homeowner.
I mean, that's also expecting them to want to serve the homeowner.
Looks like energy stock was the big mover on Friday. Phillips, Marathon, MRO, SLB, Diamondback Energy, Devon Energy, Sunoco. They're all moving up. Okay.
We had somebody that was wanting to look at NEE. Is that an
NEE.
energy play?
NEE. I don't know. Nextera Energy. Oh. Well, I can see why they want to look at it. Oh, this is on a 3-month chart. Why am I on a 3-month chart? Okay. Anyhow. Okay, we can take a look at that a little bit later, sure. Let's go take a look at the stock heat map and go look at the weeklies. All right, so that's interesting. So we had a lot of big energy retracing, but a lot of the smaller energy producers moving up. So we got a lot of mixed stuff. What was the move on the last day? All energy. Okay. So energy was mixed on the week, but everybody pushed into energy on Friday. That tells me inflation protection. People are looking for inflation protection. So that suggests to me that CPI is going to, in fact, be high. People are hedging for inflation right now and Fed rate hike. Okay. All right. So after looking at all of this, I'm pretty convinced that we're going to see the Qs in the tech sector retrace back down to 360 easily this week. This range is going to be important for it if it holds down. If it holds 360, then that would be good for market recovery. But if the Fed ends up hiking rates, let's see, 350, 850 is the line in the sand. It looks like breaking below 350, 850 would trigger a sell-off. And then below that, you have support at looks like 348.50. So go ahead and mark these prices over here on your Qs chart, fellas. MACD looks like it is making a third crossover to the downside. And the volume direction candles have spiked through its moving average. That last little candle shows major downside action. I know the price action's not crazy, but high volume spike and the price shooting up and then shooting straight back down that formed this hanging man candle suggests a market turnaround to the downside. Let's go look for where else we have some value. Nvidia's Nvidia's head and shoulders is finally starting to shape up. It's at a bit of a slant. I'm sure it's really wonky because of this earnings gap up. But Nvidia has a lot of room to move to the downside now. So this could be one of the tech stocks that takes the biggest tumble. It's really overbought. It's very wicky as well on the daily. Seems like it's very much range bound right now. Let's go down to the 1 hour chart. Okay. So I've got some levels here set up on Nvidia as my main bearish play for the tech sector. Nvidia's been carrying the sector for the most part. Between them and Tesla moving up so strongly in the past couple of months, if these ones start to let go and fade back and give control back to the bears, then that will probably cause quite a bit of retracement throughout the market. Okay. What I'm expecting for Monday with NVIDIA is for an attempt to recapture this support here. We had a really big spike to the downside, but if we end up holding this gap down and continuing to move down through these moving averages, once we break 420, I think that's it for NVIDIA. It'll start heading back down towards 400. And if NVIDIA does end up breaking all the way down past 400, then I'm not entirely sure where it's going to go from there. The one thing to watch for is for NVIDIA to hold up support along this neckline for this head and shoulders pattern. If it does end up holding it and it continues to bounce around to the upside and break up and out, then it's just going to invalidate this head and shoulders once it crosses 440 and then break further up. So if that happens, then, you know, this entire thesis is invalidated. Once you see NVIDIA break 430, I would say that's your bailout point of any short plays. So that's where I would be placing stops on any swings. If you guys are going to mostly be doing day trading, though, then I wouldn't worry about it. Just play the trend. As far as trends go, I see that we got a double top right here. Right here within this, the right shoulder. So I'm feeling pretty good about a start to the downside tomorrow. Might finally be ready to play NVIDIA back to the downside. We'll see. All right, let's go take a look at Tesla. Tesla's been absolutely disgusting lately. Well, Tesla is still moving according to my chart. It held up support, formed a bullish pennant. It's holding up. It broke that resistance, and it's holding onto it at 275. It's just barely below 275 right now, but that's still good enough. So my chart setup suggested that it's going to make a break for 395, 396, thereabouts. I would probably cash out at oh, I said 390. I mean 290. I'm sorry. All right. So this is Tesla's setup. Got a really nice looking bullish pennant, holding up support very nicely here at the 274, 276 range. And if we break out past 280, then 290 is the target. Boulay ought to be really happy with that call. I'm also liking the look of the MACD. It's relaxed nicely here, so we're back down into the oversold territory for the MACD oscillator. So that is a good support for a bullish thesis. Volume direction candles are still looking good. The volume's been petering out, but we're still above the moving average here on the volume direction candles. It's been negative for at least several hours. Let's take a look at the daily. Okay, on the daily chart, volume direction candles still look good on the daily chart. MACD is starting to weaken a bit. So my thinking is we get one last push from Tesla to the upside. And it'll probably follow the rest of the market once CPI gets announced, and if the market thesis starts to support a Fed rate hike. So I've been chatting about the major tech sector stuff for a minute. Do you guys want to? I've been missing a lot of chat messages. I was staring at the demon's floor because I'm so used to looking at that. I'm sorry, guys.
No apology needed.
I had some housing info if you want me to chime in on that.
Go for it, Echo. I'm catching up on these chat messages, so if you'd like to go over the housing data.
So, not much actual charting data that I've been looking into. I've mostly been watching the trends and what's been going on in the Central Ohio area. Currently, housing market is just kind of average for homes that have already been established for more than like 10 years. However, the subdivisions that are going up like crazy in this area, the houses are going for like 480K to 500K right now.
Jesus.
And these are just standard cookie cutter houses. There's nothing absolutely special about them at all. They're standard 2-story houses.
What's the square footage on these things?
I gotta do a quick look on that. While I'm looking that up, also average housing APR for mortgages more into the actual Columbus area is about 7.15 to 7.5 on the rate. More outside of the actual Columbus metro, it's pushing almost 10.
Oh my God!
I'm not joking. 10%. It's probably on average it might be just under 10, but when you're talking about like between 8 and 10%, it's just fluctuating between that. It's pushing 10 though.
I already know that like most people in Ohio, Central Ohio, cannot afford that kind of a rate. There's no way.
Well, what's even crazier is that where I live, and they're just throwing these houses up. I'm getting people coming in at my work, and they're saying that they were selling their house, these same houses in the actual inside the 270 Outer Belt area of Columbus, for like $1 million.
What the?
And I mean, I'm still trying to find information to confirm these things versus them just shooting their mouth off. So that's just hearsay so far. But I've had enough customers come in saying that the houses are pushing that value in Columbus. That's the reason why they're buying them so fast out here, because they're half the price out here.
What the hell?
It's pretty much what I'm saying on it.
What's going on in the job market in Columbus that would be triggering that? Because that doesn't make any sense to me.
Well, for where I'm at, for where Central Ohio is on the east side of Central Ohio, we've got Intel.
Okay.
There's Intel coming out. Amazon's already bought up a lot of stuff out here. And a lot of it's Intel, but then also just people moving in from other states. You know, it's other incentives. They're getting away from environments, and they're looking at the housing prices. So between that and the Intel thing, they're just coming out in droves, which part of me is kind of like, they just broke ground in that area for Intel. Just broke ground. They haven't even laid anything in the dirt yet. So for them to say we're out here for Intel for jobs, I'm kind of like, unless you're a construction worker, there's literally nothing out here for you, and there won't be for a while. So
it's quite a gamble.
It is. And these are young families. A lot of the people that are coming in that are buying those houses are probably mid to late 30s at the most, with new or younger families. So it's kind of got me shaking my head that they're buying houses at these prices with this APR, hoping that sticks. Because, I mean, once you get past within a 20-minute drive east of Columbus, it gets very country very quickly.
Right.
It's not. It's
I've
not
driven.
huge. It's not huge job market out that way. So
Yeah.
I'm just kind of like. I mean, I think in that area, in one of the areas that houses are going up, there's probably 100 to 200 houses already up, and people moving in. They're renting these houses for at least $2,000 to $2,500 a month. Some of them.
Yeah. The closest you're going to get for like another tech job is you're going to have to drive an hour and 20 minutes to Akron for tech jobs at all. And Akron's pretty slim still. Like all you have is Akron University and a few like small tech companies. There's not a whole lot beyond Columbus. So if that ends up
Num
not working out, then people are going to be stuck with those houses upside down in them. There's also a foreclosure crisis coming. So Ohio is going to be one of the states that gets hit with a big foreclosure wave
Oh,
in the next 6 months.
oh, I don't doubt that. Posted in trading floor that Illinois got 9% APR, or they're pushing it from them. But yeah, it's getting ridiculous with the housing market around here. The houses that they're putting up, I'm like, at the most they're worth 180, 190K, at most. That's what they were within the last. I think 4 years ago they were going for something like that.
And this is going to
So
trigger another market crash. It's probably going to happen here and now within it's probably going to happen here now before mid 2024 now.
2007, here we come again. So I was just throwing that out there for the housing sign.
Yeah, appreciate that. That's really good info. Man. All right. Right. So Tips was throwing some stuff out there. He was looking at Jets, which is the travel ETF mostly focused on airlines. Um Kind of big megaphone pattern set up here. Tip says he is targeting late September $20 strike puts for Jets. So let's see. Let's go ahead and draw some line. Eh. Yeah, it's a bit overbought. Quite a bit overbought. It does this so frequently. Like it just shoots up and then goes sideways or peters out within another couple of months. Like it does this for 1 quarter at a time. All right, let's see. What do we have? Well, the momentum is with it on the volume direction candles. So for Jets, I would probably say to hold off and wait a little bit. It could be a nice bearish play. This MACD is set up for it, but the volume direction candles are still showing bullish momentum here. So a lot of buying power is still pushing the price. The volume is moving to the downside though, so this could turn around in the near future. I'm trying to think what might trigger this sell-off, but considering the energy stocks are pushing higher, which suggests an inflation hedge. If inflation does kick back in again and we get a little bit of we get a hot CPI report, then that could raise fuel costs for jets, increase travel costs, and that always hurts the Jets ETF. So I got a good. I think Tips could be onto something here, if a bit early. I'm suggesting that on the technical charts it looks a bit early yet to make the call, but the setup is there. I would wait for some confirmation. Oh, let's see. ADP employment change. Tips was sharing this data. So let's see. What is this? What is this? Is this on the economic calendar? We have the unemployment rate, which came in at forecast of 3.6%. How come I don't see ADP employment change anywhere on my economic calendar?
Hey, TV,
Oh.
can you hear me?
Hey, Tipped. Yeah, I can hear you now.
Hey, so I was having a mic problem earlier. Yeah, if you scroll down a little bit more, I threw that in with the Cleveland Fed prediction. They are predicting a core inflation and CPI increase for next month, as well as the ADP employment increased by almost 250,000 jobs last month.
Okay. So employment good, CPI bad, all
Yep.
pointing towards Fed hikes.
Yep, pretty much.
All right, time for the time to go on the next dip on the roller coaster. Thank you. That's helpful information. Okay. Core inflation nowcast. Let's go take a peek. Okay. So the inflation year-over-year percentage change table that Tipped posted, it's just a really short thing, but the expected for July is a 3.61 rise in CPI, with core CPI going up 5.22. PCE prediction 3.61, core PCE 4.65.
Still on Jets, TD.
Yeah, I was just showing it on the recording since you guys have it here in the chat. Okay, so the discussion on CPI, I won't beat a dead horse. The expectation is for CPI to run hot. Appreciate Tips input. So with a hot CPI and with jobs doing so well as a an increase of wage growth, shows that Fed's almost certainly going to discuss a rate hikes for the next quarter. So, and they're never going to do just one. They're going to do a series of rate hikes in order to start applying some more pressure to the market. It'll probably be smaller rate hikes, most likely 25 to 50 bips. We might get a 75, but I doubt it with the progress that's been made so far. I don't think they'll feel the need to apply that much pressure at once, especially with inflation fears, running rampant everywhere. The narrative has been exhausted. Everybody knows that, the inflation situation is, absolutely awful. But they're still trying to push this like there is no recession. There is no recession in the United States. Anyway, let's go back to the stock heat map and look elsewhere. Let's see. The push in tech is all but over, I think. All the chip manufacturers, with NVIDIA as the one and only exception, are starting to retrace now. Micron, Qualcomm, Intel, AMD are all retracing again on the week. We have energy pushing on the last day of the week. We have retail retracing. We have industrials retracing. Health services retraced throughout the week, but had a push on Friday as well, along with energy. It was a very small one, but health came back a very small amount at the end of the week. So all this suggests to me that inflation is certainly going to come in hotter than expected. So we'll go ahead and prepare accordingly. So for Monday, let's go ahead and put SPY up. SPY, I would expect to have most likely a gap up and a push to the downside. I think that we'll probably see an early gap up on Monday. Most likely start at around 440. We'll see how the futures shake out throughout the evening, but I'm betting what we'll see is an early open and a push in the morning on Monday as a resumption of trading going into or coming out of the 4th of July week. And then for the remainder of the week, a push to the downside with, I would expect we'll probably chase 430 by the beginning of August. So we'll see the next couple of weeks pushing the SPY towards 430. And once the tech sector begins to follow suit, especially if the tech sector tumbles with major chip manufacturers pushing to the downside, then we're going to probably also see the Qs tumble across the entire tech sector of the market. So Tips was pointing out. Tips was also pointing out the trend for Nasdaq showing bearish divergence. Need to double check what that time frame was. Large bearish divergence. Oh, that was a daily. Okay. Well, it's just barely there. But yeah, I would call this a double top in either case. We have a very clear double top. This 20 EMA is a strong area of support, but if Nasdaq breaks 14,700, then our next stop is going to be 14,250. Total lack of buying pressure at these levels. It's just no buying pressure here. The resistance from the low 15,000s coming out of 2021 is going to be really hard to break through. So I would expect Nasdaq to retrace pretty hard, especially with rate hike announcements. So we're going to have CPI rate hike announcement most likely chasing that figure. You guys can play it as safe as you want to, but the VIX is probably going to be a really good play this week. You can also look at UVIXY. The volatility that will come out of all of those events are bound to cause prices for these particular ETFs to shoot way up. You can play the VIX. It's so low right now that any volatility at all can send the VIX moving by more than $2 to $3 in a day. And if you play, I would honestly, personally play a 2 to 4 week swing on the VIX to give time for something like this to move in your favor. And you could do very well on something like that. UVIXY, I would play it a little bit tighter. But I think that probably with this coming week, UVIXY calls are going to be the way to go. So playing UVIXY and the VIX in the short term for between 2 to 4 weeks is probably going to be a massive yield for you. I would keep it at the money and give yourself plenty of time. UVIXY just had a 1 to 10 split, so there's no danger of a new split here in any recent or at any time soon. They do their split every year or so it takes. We had a lot of splits back during the bull market in 2016. But since we just had a split, like there's no danger of a split or a massive retrace in UVIXI, I think it'll hold very stable for a while. So this will be a good time for some good volatility to drive the market. DRV looks like a really nice setup for a harmonic. So this may be a good time to start thinking about a long-term short play on real estate as well. We're right at that support level, and DRV does really well once the market starts to turn. You can see the market is starting to like really show its hesitance, and DRV really likes that. The real estate sector lags behind the rest of the market a little bit, but when the market starts to take its nosedive, DRV blasts up fast. Might also think about some SQ calls if you're short on cash and you're not able to play if you're not able to play a full like SPY or Q put or something like that, and you want to still get exposed to those sectors or get exposed to those ETFs and you want to play it to the downside, or if you just don't have access to puts because of your options level, then you can buy calls in SQs, and that is a different way of exposing you to the market. So playing SQs to the upside can be a really cheap and effective way to short the market. I would think about this as probably the best way to play a cheap, safe bet against the tech market for the next few weeks. I really like this setup. So we'll
Just
get it.
play it like Queen and buy a shit ton of shares.
Right. Yep. Yep. Scrap Queen did really well doing it like that. She didn't even bother with the calls. Um, she just straight up bought shares of SQs and did extraordinarily well.
Yeah, congratulations to her on that. That was a killer play.
It was a killer play. So impressed. Okay. Catch up with chat. See if anybody else has got anything. Okay. Nothing so far. Thank you, Tipped, by the way, for the rate hike decision prediction. The chart that Tip posted is suggesting a 25 bips hike from the Fed by they're going to be expected to target 550, and they're suggesting that that's coming in at above a 58% probability. Box and whisker plot suggests that we're going to get more than likely we're going to get we're definitely getting the 25 bips hike, with the possibility of a 50 bips hike being a definite possibility. If we get the 50 bips hike, then you can be absolutely certain that the market's going to take a shit. 25 bips, I think that it retraces a bit and it can at least sustain itself for a little while. But if the Fed comes out swinging and just like punches it in the face with a 50 bips hike right out of the gate, then the market's going to take a shit fast. It's been moving up really, really quickly, very aggressively, and that is going to help push inflation. So they might do it. They may come out swinging. We don't know. The Fed's been very hawkish when the market acts this way. So I guess it wouldn't take me too much by surprise if we saw something like that. Let's go ahead and take a look at the bond market really quickly. Treasury bonds are indicating that recession is on the way. 10-year bond yields are skyrocketing towards the upside again, and we're back above 4% yield on the 10-year. So this treasury bond indicates a long-term bearishness. Looking at the value of businesses versus the stability of the U.S. Treasury and the dollar. With a 4% yield on 10-year Treasury notes, if this sustains its momentum and it keeps rising, then this would indicate that we are coming out of our we'll be coming out of our inversion on the 10-2-year Treasury curve, which is this. So we've been watching this for a while, and if anybody ends up looking at this later on that hasn't been in our demons meetings, takes a look at this. The 10 and 2-year Treasury curve is a 100% accurate indicator of recessions. Every time that we have inverted, it's been a 100% accurate predictor of a recession within the next 6 to 18 months. So between 6 months and 1.5 years, we go into a recession, and we're right now at that mark for the recession to be officially announced. And then once we come out of inversion, there's usually a market crash. So if we were to go all the way back, say on a weekly chart, you can track this going back all the way into the 60s. Every recession here has marked a big crash in the market. And it might be a little bit difficult to see it looking back here, but notice that every time we come out of inversion, that's when this it inverts when the chart goes below this orange line, and then after it breaks out above it really quickly, that's when the market crashes. So this little blip here, this is actually a very large market crash in the 90s. We had another inversion here, then we came out of it. This was the dot-com crash. The dot-com crash really started to accelerate after 2001. So coming out of inversion here, that's when the market really tanked. The NASDAQ took it down first, but that was when the worst of it hit. Okay, and then coming out of inversion, this was quite a bit delayed because the bonds and the stocks were performing very well in the market, but the crash was actually triggered by real estate, which was a bit slower moving in the 2007-2008 subprime crisis. But the market crash did get triggered by coming out of inversion in the summer of 2007, and then the capitulation occurred much, much later. So this was a little bit unusual, but the trend tends to be that within 3 to 6 months of coming out of inversion, there's a capitulation wave, a big, big crash that occurs in the market. And this is the deepest inversion that we have had going back since the 1980s. We haven't been in an inversion this bad. So we've been carefully watching this and paying close attention to when we come out of inversion. We're looking for this chart to crack above the orange line. So if we see that happening anytime soon, then we'll know that we are near the end of this phase of the market. So, as you can see, market is really, really trying, really pushing for a recovery. Kind of want to compare this to 2008 a little bit. Yep, it is kind of looking like it. Three very big dips in the market, and then what looks like a big cup size recovery, and then a final crash. right in the middle of recession wave. So I don't know if you guys can see this, but what I'm suggesting is that we might be at this point in the market. If we're anything like 2008 and we do see a massive real estate crash, housing market crash is bad for everything. It destroys everything that happens in the United States because our entire economy is based off of our real estate market. It's where we derive value from everything. It's where all of our assets are backed. Property and land value means everything to the United States economy. So if it crashes, everything crashes. And we're definitely heading towards that. So yeah, these two little blips here looks very similar to this one, and then we have almost a cup formation that's looking like an attempt at a market recovery. If this fails here and we end up coming back down here to retest lower lows, then market go boom. Market go boom hard. So we'll see how this shakes out. It's probably going to take us until 2024 before we finally see the true impact on the market. This will be a pretty it's going to be really hard to predict. Predicting crashes, you can look back at every crash. There was always some doomsayer that said it would happen here or there at some point, and no one's ever 100% right. So I don't expect to be 100% right either. But if I can even just be close enough, to give people a heads up, then I'll call that a win. If you can survive the bear market, you can survive the worst conditions, then you can survive in any market. This is going to be the scary part where bulls get the rug pulled on them if this market recovery doesn't continue. So that's what everybody's looking for. And if the Fed starts raising rates again, that could tip things over the edge. We've already had 2 major bank failures. We've had some mid-sized banks failing and struggling really hard. The market is in an early recovery phase, but this is the time in long-term major crashes that that people realize that they got way too ahead of themselves, and the market pulls the rug on them, and then they finally give up. They give up, they get angry, they sell it all, and then the capitulation hits everyone in the gonads. So play it safe, keep your cards close to your chest.
Fuck you with a cactus.
Hey, TD, I know you're getting close on being out of time. You want to talk about one of your babies, Sensionics?
Sensionics.
Yes,
take
sir.
a look at it. Sure. Oh man, it hurts to look at, to be honest with you.
I know, but it had some nice action this last week.
Yeah, it's down below $1 though. Ugh. It's a little bit of action. I'm not gonna get too excited about it. At least their earnings were break even. I'm glad to see that they're breaking even now. Even going positive a couple of
I
times.
think we had a few people that were scalping it.
Well, that's really good to hear because I'm still holding all my Sensionics. It was a 5-year hold for me, just like Biora. So between those two, I'm pretty over leveraged and I'm holding on for a long time. I've still got calls that don't expire until 2024. So if either of these get sent, it would be life changing for me.
Real quick, TD, you were talking about those financials before you get far off, and I'm gonna forget. The Finner scan, I ran it, and tell me why a bunch of fucking financial tickers are coming up. Coastal Financial. It was just like a lot of fucking banks were popping up on that Scourge bot, bro. Like that had me real weary on what the fuck's coming.
Oh, that's scary. Because I'll be honest with you, ScourgeBot, while it does find those gems, you have to really know what you're looking for. Most of the tickers that ScourgeBot calls out are things that are getting beaten down, pummeled, and doomed to failure in the long run.
Oh
So
yeah, so a whole lot of I had a lot. I mean, I don't know them off the top of my head, but Grilled and I were going through it, and I ran in through at least 7 of them.
ooh. Compile me a list of those, Boule, and we will go through those at some point later on. Maybe share that with the PI squad, and we go digging through those. But yeah, that does suggest to me that financial sector, especially small and mid-sized banks, are about to start dropping like flies. I'm really
Most of them
concerned about
were
that.
most of them were smaller banks. None of them were like the major banks, but most of them were just this fucking. I think there's just this small bank that's gonna try to take some blame for somebody.
Yeah, it could be smaller banks operating under licenses of the larger, like the Big Ten.
Hey, Boule, can you link the scan here?
Yeah, I'll post it here in a minute. I'll go through and I'll find it. I just wanted to get that out there before I forget.
I appreciate that. I didn't know about that. So, um, for those that may not know what Boule is talking about, is our ScourgeBot FINRA scan looks for very large amounts of short exempt volume in unusual places. Um, and it's based off of relative volume. So when we see large spikes of shorting volume and short exempt volume, it's usually a sign that big players are messing with a ticker. And occasionally that creates opportunities for short squeezes, but you have to be really careful about that. For the most part, when you see that happening, it's because there's a big player that's trying to stomp out competition or beat down a stock in order to, put it into the cellar, basically force a ticker to delist. So there's opportunities on both sides of that trade. You can play it to the downside and make quite a lot of money over the long term. And you can also like catch it during a short squeeze to the upside and make a lot of money that way. But long term, most of those tickers that the FINRA scan calls out are companies that are being beaten down to death. And that's usually where the story ends for those companies. So to see a lot of banks there is really terrifying, because a lot of those banks won't be protected for most of their assets. And that's going to put a lot of people into a world of hurt. Because those smaller banks, think small banks, credit unions, mortgage originators, all of those guys are the ones that don't have their assets backed up by FDIC all the time. And there's others that operate in like the subprime markets for car loans and housing loans. And those guys are not protected. So if something happens to them, those assets that get when they declare bankruptcy, those assets get washed out and eaten alive by the debtors. So who's ever holding the credit for those companies are the ones that get everything. Shareholders get nothing. And if they're not insured, then whoever had their money stored at those banks, they lose it all. Like, it's just gone. So people lose their investments, their retirement. all kinds of bad things happen when that occurs. It's not like with First Republic or Signature Bank where FDIC steps in and insures the companies and the people who had their savings tied up in those banks, and they make them whole. It's not like that. So if that occurs widespread for a bunch of small banks, you're gonna see a lot of people getting wiped out all at once. And that can trigger, when it happens to one bank, it starts having a contagion effect. Just like how we saw Silicon Valley and Signature Bank go under, and it caused a bunch of other bank stocks to collapse for a short time before they recovered. That can happen again. And rate hikes are part of what triggered it. The rate hikes themselves may not have actually caused the pressure on the banks, but the rate hikes did cause other people to think that that was what was causing it. And that panic, when it sets in, can cause stocks to tumble, cause assets to lose value, and that forces them into a position of like, well, we need to sell it or die, and that triggers a domino effect. It's like an avalanche, and there's no stopping it once it gains up enough of momentum. Those are the kinds of events that cause panics, like the panic of 1891, 1909, the stock market crash of 1920, 1929. You can look back at basically every crash that's ever occurred, and it always starts out with one major bank that gets scared enough and they just sell it all. I'm going to go ahead and take a look at Biora since that one's been a topic of conversation also. I see that they had quite a big pop recently, so they're getting interesting again. Biora had to do a reverse split back at the beginning of the year. They had a big pop and found some resistance up here at a ceiling, and then trickled back down, found some support, and then just recently it's been gaining steam. So very strong support here. I've actually liked. Oh, whoops. I've really liked seeing this this floor here, just under $4. Kind of expecting Biora to start turning around now because of their financial situation has finally started to turn around. They sold off their diagnostics business, which I did not see. This is new, so finally they've finally found a way to profit off of their diagnostics business. That was actually a massive, massive, massive win for them. So when they created the diagnostics business, they created a detective measure for determining preeclampsia likelihood in mothers. It's actually the second leading cause of maternal death in pregnancy. Preeclampsia is pretty aggressive. And it's basically like uncontrolled bleeding during labor. But without going into too much detail of the medicine, the biggest prevention is for preeclampsia is early detection, and their diagnostics were the best in industry at the time. So when they did find that, that was a massive, massive win for them, and it opened them up to a huge market. It was actually something like a 800 million to a $1 billion market. But they couldn't move forward with manufacturing, so they're ready to sell the diagnostics business. This was something that we were hoping was going to happen earlier on and be a way for Biora to make a huge chunk of cash so that they could spin up manufacturing for their biotherapeutics business, which is the real moneymaker, which is this is a $20 billion market for medicine sold by AbbVie, Humira. So anybody who's been following me for a long time knows that I love Biora Therapeutics. This is one that I'm particularly excited about for the long term. I do have quite a lot invested in this. And I think that now that this news has hit, they've completed the sale of assets for the diagnostics company. That gives them more than enough cash to get them through their manufacturing phase for their biotherapeutics and their oral drug delivery system. The magic pill. I see Biora has been scoring a whole bunch of patents as well. That's actually really awesome. All very, very good. I have maintained that in the long term, I expect Biora to be a multi-billion-dollar company. So it's always been a 5-year hold for me since I discovered it. Their float is now 12.75 million. Their market cap is just 52 million, which is nowhere near the value of their actual assets. The value of their assets puts them well over $1 billion. Their patents alone could be sold for hundreds of millions. They have more than 100 patents at this point, and it's all surrounding their oral biotherapeutics delivery system. So the sale of their diagnostics platform is extremely encouraging to me. Having the context of knowing what they have in the pipeline and that now they finally have cash in the bank that they can get it to distribution and sale phase, that pretty much that's a massive peace of mind for me. It was really hairy there for a long time, but now I feel immensely confident Biora is going to do so well. I hope they don't sell out. I hope they don't sell themselves to a bigger firm. I hope they stay independent and keep growing, because this is everything that they've been working towards. I'm so excited. Very happy to see this. Oh, BBIG. Forgot all about BBIG. We'll just go ahead and move on.
Hey, TD, check out this ticker right here. Let me know. I haven't seen it, but the Scourge bot brought it out, and it's Pro Shares Ultra Short Triple Qs. It's QID. I'm only bringing this up because you were talking about the Qs and how it looked like it wanted to take a breather.
Yeah.
If this is a inverse of that, and it's only like $13, would that be like a poor man's?
Yeah.
Like a TLQ kind of?
Yeah, this is kind of like playing SQs. This is basically SQs, except this is maintained by ProShares.
Okay. Yeah, the Scourge bot likes this one for some reason.
All right. Yeah, QID and SQs.
I think I'm gonna have to do some SQ positions tomorrow, dude. Like straight up.
Yeah. Okay, QID is basically SQs, but it's not leveraged. This is a non-leveraged short Qs ETF. So if you don't want to play with leverage, this one is a 1-to-1 ratio, short with the Qs.
Cool. I
Whereas
didn't know that.
yeah, whereas SQs is 3 times leveraged. So whatever if Qs moves to the downside by 1%, SQs will move up by 3%. It's a ratio leverage. So
Gotcha.
this is a cheaper ETF, but it won't move as much in the event of a major downturn in the market. SQs is riskier because it declines in value faster over the long term. But you're only ever playing it short term anyway. So if you think that the market is going to take a shit within the next 3 weeks, then SQs is a great play. You just buy a call in SQs and just watch it go take off as the market's shitting and you're laughing all the way to the bank.
Roger.
I'm looking at, I think QID was just coming off of its all-time low also, though.
Yeah, but remember that's because the Qs are at a high right now, and remember that when you have these short ETFs, the inverse ETFs, they're always going to be declining in value constantly over the long term. So because of rebalancing, it's always going to be at an all-time low with little pops in between. So you're not looking for trends with those short ETFs, those inverse ETFs. You don't want to do technicals based off of those. You want to do technicals off of the main ETF that they track, and then just make your bets inverse. So if you see Qs are going to go down by, let's see, I'm predicting Qs to make a move to the downside of 2.26% this week. Okay, so we're looking for a 2.25% move to the downside in the Qs. So my expectation is that in the next 2 weeks, that SQs is going to go up by 6.75% by comparison. So that's how I place my bet accordingly. So do all your technicals based off of the main ETF, and then whatever move to the downside you see, just place your bet on the inverse ETF accordingly. And for the
Very
most,
much so.
and for the
Be
most
like an
part,
SQ.
yeah, and for the most part, definitely get a refresher off of my video that I did. Spy on a budget. Yeah, trading Spy on a budget will teach you all about trading these ETFs with inverse and leverage, with leverage plays for both bullish and bearish bets. It goes into a lot more detail than I have time for here. So I went ahead and posted that in the Discord. You guys can check that out and just give yourself a refresher on playing with those ETFs. It really does help. The leverage is nice, especially if you're doing day trading or just like 1-2 day swings. It's very, very nice. If you know the market's going to move by like 2 to 3% over the course of a few days, those ETFs move so much faster. You can 2-3 times the number of gains that you get in that span of time. Actually, my best month, I went from $2,000 to $12,000 in just I think it was 2 weeks playing short on the SPY by having bullish SQ calls. Anyway, yep. Just follow that.
Hell yeah.
Good luck, guys. What else do we got? Somebody was mentioning Netflix, suggesting that there's a look for they're looking for this gap to fill. I think that will probably be a really tough. That'll be a really tough sell because it didn't even break this resistance here. We have resistance in this zone. And it only just barely entered it. It didn't break it. So unless it breaks well above this zone, it's not going to fill the gap. So if it gets rejected off of this level, Netflix is going to come back down. So I don't remember who it was that called out Netflix. I think it might have been Chandagger. But if
I actually got a position in Netflix right now still too. It does look like it got a little weaker. But I got until I want to say the end of the month, so
okay.
A little bit of time to see if
well, if you're seeing tech sector moving to the downside, then I would bail out of that bet because Netflix is going to follow the tech sector. It's going to move along. It is a consumer service, but it trades alongside all of the major FANG stocks. So if Apple, Amazon, Google, Microsoft, and Nvidia start coming down, Netflix will follow.
So what do you think about those, DD? What do you think about those going on a fucking rampage and just breaking all kinds of highs?
Yeah, well, I've been talking about it the last couple of weeks. We've done these meetings, and all of it's been focused around like this AI advent. Like everyone's going hype on AI. And personally, I've talked about it a lot, but um, I think the AI is most likely going to start eating itself. Um, and people are going to start. We're going to start getting reports of people misusing AI for malicious intent, and government regulation will hammer it down in a hurry. And I kind of hope it does, because the uncontrolled growth of AI is very dangerous to society. It can do a lot of damage very quickly if it's not regulated and we don't implement some serious ethics control around the use of AI right now. And we kind of like just threw caution to the wind by opening the Chat GPT to everybody. And there's already companies that are making use of Chat GPT-4, which is more than 500 times more powerful. So it's insane that we're just doing this without controlling the growth of it. It could be very dangerous. So I think that more than likely the boom will come down on it. But in the meanwhile, it's caused some explosive growth, especially for like Google, Microsoft, and Meta, all of those, and Nvidia too, actually. All of those companies that have had a major focus on AI and have been talking about it for the last decade and talking about developing it, they've all benefited massively from the growth of it and the hype. So, but everything has to come to an end. And since we're talking about the tech sector getting weaker here, if it does end up retracing at this point, then um, any talk of regulating AI, any talk of like putting down regulations or ethics controls or anything like that on AI, watch for that sort of stuff in the news. That would cause these to start tumbling. Because if they start talking about regulating or putting laws down around the development and use of AI and ethics controls, then that will absolutely put the brakes on this explosive growth for these companies that are basically riding the AI hype train.
Well, you know what got to me though? Like the only thing that has me on the fence about this shit is that they're all flagging, bro. They all have this little cub forming. And I'm talking about Netflix, but I'm talking about everybody got this fucking flag on the daily, bro, that's just making me think like, okay, what direction you're gonna pick. And every day it just makes it tougher and tougher because you don't know if they're gonna, try to do some stop loss hunting, or you don't know what the fuck they're gonna do. You know what I mean? So right now I'm
Yeah.
still over the fence. I'm not fully invested on one side yet.
Well, that's why I'm saying to everybody to be really careful, because we have this trading range here. Remember, like we're back above the August highs now, and we're having another explosive growth phase. It's a little bit slower than it was in the summer of 2022, but we had this move happen before in 2022 during the bear market, and it was brought to a screeching halt when the Fed said we're raising rates now, and kicked everybody in the nuts. And August 16th, that was the last day everybody got their shit kicked in the next day when the Fed announced rate hikes and started beating the market up, and it was it was a tailspin from that point on. So and we're looking at that exact same thing happening. You can check the recording on this, Boule, if you want to. I'm going to be posting it on YouTube for the group here for everybody to take a look at. But yeah, the expectation is for CPI to be hot, job uh, job and wage growth to continue on trend, which the Fed does not like, and that's going to prompt them to raise rates. Now, it's either going to be a 25 bips hike for sure, or a 50 bips hike maybe. If it's a 50 bips hike, it's going to absolutely beat the hell out of the market. They're going to smash it fast.
I completely 100% agree. The only thing is, um, the market has been super fucking weird, bro. For shit that's supposed to make it go down, it's been going up. Um, I think there's just some real big key players in this shit that don't want to see it die, that are just trying to hold it, and it's just hanging by a thread type shit.
Yeah, well, those big players, they did the same thing in 1929. I'm looking at I'm looking at I'm
Yeah.
looking at the man himself, James Chase, James Chase, fucking or James Morgan, tried to hold up the market all by his lonesome in 1929, and he got cleaned the fuck out by 1930.
Yeah.
In 1930, he lost everything. He died penniless. Lost everything. All of his personal assets got wiped out because he did that. The bank did fine, but he was out. So the when the market turns, you don't try to hold it up by yourself. And these banks have done that. They made that mistake so many times. But I'm looking at the writing on the wall, man. Goldman Sachs is selling off their Goldman Sachs is selling off assets and portions of their business right now that are not performing well. I'm trying to remember what the latest thing that Goldman Sachs sold.
I hear you on that though, man. I completely fucking agree with what you're saying, 1,000%. The only thing that I don't agree with is the way the fucking market has been performing. You know, like I've been to the point where I'm looking at my bets, TD, and I'm like, what the fuck am I betting on and why?
Mm-hmm.
And I fucking win, bro. I take a big ass, a big ass gain. I'm like, see, this is not how I want to fucking trade. I want to trade on pure fucking technicals and just like the way it's supposed to be. But now they have a hold of it to where they can fucking downtick that shit and make it come like what the SPY did the other day, bro. It fucking had this stupid V-shaped recovery. And it was like, where the fuck is this coming from?
And then they
But I
slammed
think
it
like
back
if
down by the end of the day, like in a
yes,
single
dude,
hour.
that was fucking insane, dude. Like,
Yeah. Yeah, I saw it. We were analyzing all of it, and I think that it's a sign of what they're going to do next. By the way, it was Apple Pay. Goldman Sachs is selling their Goldman Sachs is going to sell their portion of the business where they handle the transactions for Apple Pay and the loan or the credit facility. They're not going to allow people to pay for things on credit, or they're selling the portion of their business that handles Apple's credit. So whatever people buy with like their Apple credit card and shit, Goldman doesn't want it anymore. And I think that it's because it's a sinking fucking ship. This was discussed in the last meeting, but credit card debt is at record highs. It's actually been at record highs. We're going to take a look at this before I close out the meeting here. Let's go ahead and look at this. No, we're looking at consumer loans and revolving credit debt. Here you go. Here's a chart that should scare the living shit out of you. This is an all-time high. Okay, we have never seen credit this out of control ever. This is the worst it's ever been. We haven't been in a situation like this since the recovery in 2010, when all of a sudden everybody got bailed out during the recovery of the subprime crash. So massive credit plans got opened up in 2010. That was when it was insane. And this all came out of a big need for credit, because in 2007, when everybody lost everything, everyone lost everything. They started buying everything on credit, using credit cards. Everybody throughout 2008 got absolutely hammered. And then the government tried to step in and save everybody and started, creating like these programs to help people pay down their credit. And it's cyclical, right? It's a big cycle every single time. Well, now we had this big wave in COVID. Everybody got a fuck ton of money. They paid down all their credit, and then they put everything right back on the credit card once everything suddenly got so expensive that they couldn't afford it anymore. And they sunk their savings into just paying the bills. Everything got way too expensive. Now we're screaming towards it's past record debt. But we've climbed 35% in just 2 years in the amount of debt that we've accumulated. This is all consumer debt. It's all consumer
That
debt.
is
More
fucking
than,
crazy, bro. What
and
the
this is
fuck?
20 to 25% APR shit. So you're paying 25% interest annualized on this credit card debt. People are going to spend the rest of their lives in debt like this. And it's pervasive because of things like Klarna and the Affirm, all of these like pay in for installments shit. Everybody's buying this shit on 0% interest and accumulating all of this debt that they then pay with their credit card, and then the credit card becomes a 20 to 25% interest, and then they get way underwater, and then they can only make minimum payments, and then they spend the rest of their lives in it, paying it off, making minimum payments, and they'll never get out from under it. And this is happening across the entire United States, everywhere. So this is everywhere right now. Okay? So this is eventually going to catch up with the banks when people can't pay it anymore and they stop making money on all the credit. That's where this carousel comes to a screeching halt. When the merry-go-round stops is when all the bank stocks start to crash. So it's happening in everything. The interest rates on everything are becoming absolutely unsustainable. Nobody is going to be able to afford anything on credit anymore, and that's when it gets scary. People can't afford to live anymore. The fact that we are paying our bills, our food, our rent with credit cards, and when we run out of money, we just get another credit card and start the whole cycle all over again, do balance transfers and shit, and then hold on to the 0% interest for another year. Eventually, people stop qualifying and then they realize, oh shit, there's no way out except to pay it, and I can't. And then everyone starts losing their jobs, and then the companies start going under, and this and that. It's starting very soon. 2024 is when it all starts coming to a head. I said that in 2020, I said in 2022 that this year we would see the real estate market start to collapse, and we have. And now we're going to start seeing the credit cards catching up with everybody. We already saw car repos beat everybody up. Now car inventories are way up. So now there's going to be a big crash in the car market. That's my thinking. Proxy, let me know if you see anything different. But my opinion is that the car market is about to crash once the inventory swells too much and nobody can qualify anymore when the financing gets too crazy. And the way that everybody is just continuously accumulating consumer credit card debt, it's becoming unsustainable. It's going to come to an end eventually. And when you see big banks like Goldman and Chase and Morgan Stanley and all these other assholes, the big five, when they start selling off entire portions of their business that surround consumer credit card debt, it's because they know that it's going to collapse. They're getting out, okay? They're cashing out. They're getting the hell out. They have ridden the gravy train for as long as they can, and now they already knew that the bridge was out at the end of the tracks. So they're getting off at the last stop saying, here you go, here's your train, have fun. we'll sell it to you for X million dollars. And yeah, have fun.
I think people still qualify. It's just the interest rates are so high that most people are not going to take that type of a loan on an automobile.
No, most people can't. And that's why I think that this is about to come to a screeching halt, is because the debt facilities have gotten so out of control at this point that officially they are officially the debt facilities have become it's the Ouroboros, the snake eating itself. The machine has started to devour itself. As people
They,
continue to accumulate this debt and they start paying less and less and less of it, and they keep getting these deals for like 0% interest for a year, once they accumulate that much and they stop being able to pay it, they just declare bankruptcy and then banks have to eat it. So they're gonna start selling off that debt to anybody who's willing to buy it, and well, they they get
the
left
bad
holding the bag. They're looking for bag holders at this point because it
the
will
bad part
collapse.
is the bad part is like what Prox was saying, like their inventories are starting to swell. Now the dealerships are going to be stuck with all this inventory that they can't. Nobody's going to finance them because the interest rates are so damn high.
Yeah, exactly. The same thing's going to happen with houses as well. People, the sellers, and all of those, all the small time sellers and the local real estate companies that have accumulated an inventory of houses, they're not going to be able to find qualified buyers anymore. Most people aren't even willing to shop for a house right now, except the people who were able to be sold a lie that the prices are never going to come down. They're still saying that prices are going to rise 12% for another 5 years, which is so insane. Like it's not gonna go on forever. But they're convinced it is, and they keep telling this to consumers, people who are buying houses that don't know any better,
Yeah.
and those people are going to be stuck upside down in a house with a massive interest rate, and the value is going to be cut by anywhere from 20 to 40%. Could be in some cases. It depends on the local area, but it's going to be really bad for some people, and for a lot of people who are in those situations. If they lose their jobs, that's it. They have to sell for a loss, and they lose everything, and they sell or get foreclosed on with a massive debt hanging over their head, and it'll ruin their lives. And this is going to happen by the millions. Talking about millions of homeowners, I'm estimating by the numbers that foreclosures are going to go up by anywhere from 5 to 8 million over the next 2 years. We're going to see people losing their houses and getting put out on the street by the millions. It's a really scary proposition. The government's going to have to step in, but it's going to, hyperinflate the dollar again. It's going to start this cycle all over again. We really backed ourselves into a corner. The situation's become dire. See, Prox had a question. Let me read this. We
I
have some
think you're right,
denials.
though.
Prox says, oh, I see. Had some denials, but the majority of the time, you're right. The consumer just doesn't want a high interest rate. One question I did have, and I think we talked about it before, but why the smaller banks and credit unions are repeatedly beating big banks with interest rates seems counterintuitive. It's because they're desperately competing, really. They're desperately competing so that they can get, for houses at least, the smaller guys, their focus is on originating the loans, and then they sell them up as they sell the loans to a big bank to be packaged up as mortgage-backed securities. But
But that's
the
why they're hitting the FINRA scan, like Boulay was talking about earlier.
yeah, a lot of those guys are going to get over leveraged, and they're going to get swept up when they don't have enough collateral to back up the assets, and the big banks stop buying the mortgages. If they stop buying the mortgages, then their entire business model collapses, and we're going to have 2007 all over. That's what happened last time. Right now, Freddie Mac and Fannie Mae have to buy the mortgages, and all these smaller banks make a really good killing off of it. But the regulations are so strict now that people who can't qualify won't be able to get a loan, and Freddie Mac and Fannie Mae won't buy the mortgages. So they're going to other big banks that are willing to take a bigger risk, but when Freddie Mac and Fannie Mae stop buying the mortgage-backed securities and they stop packaging these things up into larger assets, and eventually it becomes too risky for the big banks too and the hedge funds, then their entire business model dries up and they stop having a way of generating revenue. When that happens, then the tidal wave of bank failures and credit union failures and all of that shit, that's when that happens. And if they can't sell the debts to anybody, then they're stuck with it. And they have to start shuffling assets around like people's savings in order to make up the shortfalls. Eventually, one bank or a few banks will do something really stupid. They'll play with money that isn't theirs. They'll get caught. They'll get hammered by federal regulators. It's just a big cycle. It's bound to happen again. But the last 3 bank failures that we had just in the last few months it was only the beginning, guys. It's gonna happen again. I'm well past my time. I gave you guys some extra time because we had an interruption in the middle of the meeting. I appreciate you guys' patience. Yeah, my cat is a fucking terror. But thank you guys so much for joining us for the meeting. If you guys have any other requests for me, demons, always remember to leave it in the Devil's Wishes channel for further analysis requests that I will get to as I am able to. If you miss this meeting, I'm going to publish it for the entire trading floor. You guys can see what these meetings are all about, and you can check it out for yourselves. Please give me some feedback. I will publish this to YouTube on a. I'll make this one public actually, and give everybody a chance to kind of see what this is all about, and let people know that I'm alive, because I think that a lot of people on Twitter are starting to question if I'm actually okay, and I am just very, 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 very busy.
Yeah, how's your job, TD?
Yeah,
Has it got any better? Or
Yeah, appreciate it, TD.
no problem. The job's okay, Phil. It's just I'm in a leadership position now, so I don't have the time that I used to anymore.
But that's good and bad. I mean, you at least you're promoted, so to speak. That's good.
Yeah, it's good. Better pay, more stability, more job security, but it's just hard to keep up. So, and yeah, I've got way too many eyes on me, so I can't do the YouTube thing
Yeah.
like I was before. But I'll publish this and let everybody know, just to let everybody know that I'm okay. And yeah, I hope everybody enjoys their trading week. Remember what we talked about. Markets looking like it's about ready to make a turn to the downside, focusing mainly on the tech sector. Inflation is likely to go on the rise, so energy is going to be a big winner. You can check out the XLE index, or you can play big ticket energy stocks like Phillips 66, Chevron, Exxon Mobil, and other oil tickers like that. Or you can just play the XLE sector. We looked at DRV and to go up. That's the short inverse real estate ETF. So we're looking at XLRE to go down. Probably not super fast. Our big play this week is probably going to be the Qs, though. Qs to the downside, mainly focusing in on chip manufacturers such as NVIDIA and AMD. Also secondary, keep an eye out on others such as Meta, Netflix, Tesla, and Microsoft, Google, and Apple. All of those are way overblown. They have taken massive leaps to the upside, and if they do not break through this resistance above to continue the bullish trend for a market recovery, then we're due for at the very least some retracement. If the Fed comes out swinging with a 50 bips hike and the CPI is extremely hot next week, then expect the market to turn fast. Be ready for it. You can also take bullish bets on UVIXI and the VIX in order to hedge yourselves against volatility. If the market does turn really quickly, be damn sure that those tickers are going to shoot up fast. You can make a good killing on that as well. So thank you guys all for joining us on this rare event
BTD.
where we open up the Demons meeting to the entire trading floor.
Before you cut it off,
Yep.
if you're going to publish it to YouTube, for those that followed this far, if you want to join Hell's Trading Floor, it doesn't end here. There will be a bunch of us in here once the futures opens, and we'll be using the bot and talking about stock plays and everything else for tomorrow.
Thank you very much, Num. Yep, as always, I am not the sole soothsayer of Hell's Trading Floor. The entire community of analysts and the mods here are constantly working, analyzing the market, and always watching the futures during the weekends for opportunities in the weeks to come. So be sure that we have a really good, strong community of very good, talented traders here that you can take advantage of the knowledge and experience of. Thank you for the plug, Mum, and thank you everybody for attending, and thank you all for YouTube for your interest in watching this far. We will see you guys next time, but until then, have a hell of a time in the markets. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more, and if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.